Welcome to Objective 4 in Unit 1 of Accounting 3310. In this objective, we're going to look at the difference between a cash basis system and an accrual-based system. So far, we've recorded business events into journal entries, and we want to pause here because the system that we have used without deliberately making a choice has been the accrual system, and yet we can gather from a business event both cash information and accrual information. At the end of this objective, you'll be able to explain the similarities and differences between cash basis accounting and accrual basis accounting and see how information is summarized under both financial reporting systems. Published financial statements from public companies use an accrual basis system, but they provide one financial statement that's cash-based, the statement of cash flows. And so we have an acknowledgement, even within generally accepted accounting principles, that there's a use for cash-based information as well as for accrual-based information. Let's take a look at what we mean by an accrual basis. What we mean is that revenues are recorded when earned, rather than based on the time in which cash changes hands. Expenses are recorded when the expenses are incurred, rather than at a time that they're paid for. So if you look at the timeline here on this slide, there are a lot of events involved in an operating cycle to provide goods and services to customers. They may be an initial order placed by a customer, and then a period of time in which the order is executed and we manufacture that merchandise and we receive supplies and we pay employees, and then finally there's a point in time at which delivery takes place and we provide the customer with the product the customer ordered. Then, once it's been delivered, we send the customer an invoice shortly thereafter, and the customer pays us eventually. Notice in an accrual-based system, the time when revenues and expenses are recognized is when we've fulfilled our obligations to the customer, which is at the time that delivery takes place. All of those other events are important events in the operating cycle, but they do not trigger revenue and expense recognition. In a cash basis system, it would look very different. In a cash-based system, revenues would be recorded when the cash is received from the customer, and expenses would be recorded when the items are paid for in cash. So, keeping the exact same order of events, we can see that a cash-based system in this series of events would have expenses recognized long before revenues are recognized, because in a manufacturing setting we have to receive all of the resources that are going to be used to make the product, and then we have delivery, invoicing, and payments happen perhaps a long time after delivery occurs. So revenues are recognized at that later time when cash is finally received from customers. I've set it up on this diagram so that we in fact have years in between the expenses and the revenues. The accrual basis is the standard for the measurement of income because it presents a more complete summary of what happened during a particular year. We can see having fulfilled an obligation to a customer and the amount that we have charged the customer at the same time. It recognizes revenues when they're earned and expenses when incurred, providing a match that gives us a meaningful figure of the difference between revenues and expenses. When we have more complex revenue transactions, we can apply these same accrual principles in different ways. So we might have an instance where we are going to be providing a series of products to customers and we ask them to prepay. That's what's recognized here. So we may get an order for providing a number of products in the future as a subscription. Here we're going to be recognizing revenue each time an issue of the magazine is provided. We recognize a little bit of the revenue and we recognize the amount of the expense that's been incurred for that particular issue. Think about this sort, where we have recognition when the delivery takes place, but had we had a cash basis, we would have had the revenue taking place at the time of the order and when it was paid for, even though it's long before when the actual obligation is provided to the customer. Let's take a look at another type of customer transaction. For some companies, delivery alone isn't enough to ensure revenue recognition. If the customer accepts the merchandise only after inspection, then the sale isn't completed delivery, but only at customer acceptance. This is especially true for a lot of technology type products. So in this example, think about supplies are sent to customers throughout the month, but the customer is not required to keep the supplies until they pass the customer's inspection. So here, we're going to postpone revenue and expense recognition even past delivery when they're physically at the customer, because part of our obligation to the customer is to meet their quality standards, and that is not fulfilled until we have that inspection and acceptance. We would have a very different recognition if we were working on a cash basis. When we would pay for the goods and services ourselves would be the time when we would have the expenses, and then the much later time when we would have the actual payments. The general revenue recognition principle is going to work no matter what the actual order is. We have some businesses that work on first obtaining an order, then producing to that order, then delivering, and then having payment. We can have some where we have production first in general, and customers order the goods that we have produced, and we deliver it to the customers and then have payment. So this matches a lot of, think about ordering books or ordering clothes or something of that sort. They're already produced and sitting there and waiting for orders to happen. Or we could have a situation where we require the order and the payment before production begins and delivery happens. This often happens with goods in which it's a new customer and we don't necessarily have confidence that they're going to meet their side of the order and actually pay us. In all of these circumstances, revenue is recognized at delivery, no matter when the payment is made. There are some exceptions that we're going to talk about much later when we get to Unit 6, but right now we're looking at the usual situations. Let's take a look at how different accrual and cash basis accounting can be, even in a relatively simple setting. I'm setting up here some facts, and then we'll look at what it looks like in a cash basis setting and an accrual basis setting. Let's say that we have 2 years worth of data here, where we have cash from customer sales of $10,000 in 1 year and $5,000 in the next, and cash from customer sales in 2003. Of course, there's none. The previous year, there's no prepayments here. All of those payments are happening in 2003. We do have amounts that are owed by the customers at the end of the year, and so in 2002 we've gotten $10,000 in cash, and our customers still owe us $5,500. They pay us $5,000 of that the next year. The cash paid to suppliers for the goods and services received is $1,000, and we still have some supplies on hand at the end of the year. This is a business that, let's say, is started with a $4,000 cash investment. That's going to be the same in a cash and an accrual basis. And as a new company, we don't yet have credit, and so to simplify things, we're paying cash for all the supplies and services at the time of their receipt. We believe all of our cash receivables are collectible. That's going to make it a little easier to and simplify our sample company. Let's take a look now at what it's going to look like if we use an accrual basis. If we use an accrual basis, we're going to recognize all of the revenues, whether customers have paid us yet or not. So in 2002, even though we've only gotten $10,000 so far, we recognize the entire $15,500 in revenues. And in the second year, we recognize the entire $20,000 in revenues, even though on those sales we've only gotten $13,000 in cash. We recognize the supplies expense as the amount that's actually been used in providing goods and services to customers. Now, let's go on and see what it looks like on a cash basis. On a cash basis, we're going to record just the amount of cash involved. So our cash inflow from customers is just the $10,000, and we've paid our suppliers $1,000. So our net cash flow from operations is $9,000. Let me go back a minute. Here our income, our profitability is $15,000, but our increase in cash from operations is only $9,000. That's because we've got those customers that haven't paid yet, and we've paid for more supplies than we've actually used. So we have bigger cash outflows and we haven't gotten quite the inflows. We do have some other cash flows here that are recognized that are not a part of income. That is, we've gotten that $4,000 from our owner, and that's part of what makes it possible for us to carry on. So we actually have cash in the business of $13,000 at the end of the year. $9,000 of it came from our customers, $4,000 from our investors. When we make a balance sheet for a company, that really is an accrual kind of statement, because what we're saying here is that we have more than just cash. If we were cash basis, we would just look at our bank account and say we have $13,000. But on an accrual basis, we'll say our customers owe us $5,500. That's an asset too. And we bought that extra $500 of supplies that are ready to be used next year. That's an asset too. So we have $19,000 of total assets. Some of it's cash, but we have value in the rest of the non-cash assets as well. That $19,000 is funded through owner's equity. We don't have any obligations here. So we have a contribution from our investor of $4,000, and then we have earned from our interactions with customers that additional $15,000 of funding. Now, both types of information are useful. Let's take a look at how they relate to each other specifically. So we had in 2002 accrual-based income of $15,000, but only cash flows from operation of $9,000. And here's the exact numbers that represented that difference. The increase in supplies used cash but didn't affect income, and because we have $5,500 owed to us by customers, that decreased our cash flows over our net income. Now, let's think about this. What did the accrual income tell us? Income statement information provides data about the profitability of the company, its long-term ability to provide goods and services to customers for less than the customers will pay us for those goods and services. So from the accrual information, we can tell that we have a business that's profitable, that we're able to charge more than we need to pay in order to provide those goods and services. While a company can exist in the short run without being profitable, it ultimately must be profitable in order to succeed. If our accrual-based net income showed instead a net loss, we would have to really question whether this is a business that we should stay in or not, or whether we would be losing all of that $4,000 investment we've put into the business. Well, is accrual information alone enough? No. We need that cash basis information also. The cash flow information provides data about the liquidity and risk of the company, its short-term ability to obtain enough cash from customers to be able to provide goods and services to those customers. While the company may be profitable, it can continue to exist only if it also has enough cash to meet the demands of its suppliers, employers, and creditors. Just because we had $15,000 in net income doesn't mean that we'd be able to continue operating our business. If we in fact had more cash outflows than cash inflows, even though we were profitable, we may have to declare bankruptcy and go out of business. We could have a great idea that will make us money in the long run, but we may still not be able to succeed in business. Cash basis income tells us what our liquidity is and what our risk is. And here we are a little bit limited in our cash. That is, we can see that the cash we received was less than our full profitability. That tells us something. Looking back at the comparison of these two, we can say, we really need to work on having good customer relations and knowing for sure that those credit customers we have will make us a priority and be able to pay us. I hope that this section coming at the end of the journal entry will let you know that the information that we've recorded in those journal entries can provide us enough information to do both, to provide us with accrual-based information to answer some of the decisions we need about accrual accounting, and it can give us information about our cash position. Thank you. We'll talk to you again for Objective 5.